What's up, everybody? Welcome back to Investing Sucks. And today I'm going to be doing a more technical style of video discussing American Express and their recent Q2 earnings release, and specifically what it teaches us about this so-called recession that's happening. So, American Express is a company that is very uniquely positioned to give us some key insights into the economy and the overall health of the consumer. So, the goal of this video is going to be show you those actual metrics, what they are and what we can look at specifically, and then what they actually teach us about the economy overall. So, just a quick background on American Express from a business perspective. I'm sure it's a brand name that many people have heard of, but few probably truly understand what this business is, how it makes money, and also why it's so unique. So, the first thing you have to understand about American Express is that their customers tend to be a lot wealthier than the average customer of, say, other credit card companies. This is really where all their benefits of their business specifically stems from. It's their key advantage, and it explains why their business is able to make money in the ways it does and do all the things that it does. So it makes money by acting both as a credit card issuer, so similar to like a bank, but then also like a credit card or a payment network, similar to Visa and MasterCard. So they charge fees to the merchants that want to accept payment using American Express, and they're infamous for charging very high fees. That is one of the main ways they make money. If we actually take a look at their revenue here, then we can see how they make money, and you'll see that's probably their biggest source of revenue. They refer to it as their discount revenue. Which, if we go to the income statement here, we can see discount revenues from the quarter. It was just under 8 billion, and that was I'm pretty sure that was an all-time high for them. And then they also make money how credit card issuers would make money, which is interest on their loans. So you can see that was pretty high here. That was their second largest source of revenue, was just the interest on their loans that they extend. So that's why they're unique. They are the credit card issuer, so they actually extend loans, they give the loans, and they also act as the network. So they have insights into payment volumes that are going through their network, and they can also see things like credit delinquencies. Are people taking on more credit or less credit, which can be key indicators into the health of the economy. So they can look at spending patterns of consumers and also credit health of consumers. So that's what makes them interesting to look at. And if you really think about the business, it's almost unbelievable that the company is able to get away with these things, all because they just have a wealthy customer base that likes to spend a lot of money. They can in turn offer them rewards, and the whole business functions just as a result of that. So it is a very unique business, and we can see that based on their revenue that they are quite unique in all the different ways they make money. And if we look at their income statement here, we can see it's kind of set up similar to how you would see a bank, where they've got their net interest income. So you can see interest income here, 2.7 billion, and then interest expense, which is much less. So they're kind of making money based off of that net interest margin there. And then they also have this provision for credit losses, or PCL. So because they are extending loans to their customers, what they are required to do by accounting rules is make an estimate on how much of those loans that they made in the quarter are going to end up being uncollectible. Now, this measurement can change depending on a lot of different things. It can also go up if they just think the economy has gotten more risky since the last quarter, and they think because of that, of the trends they're seeing in everything from a macroeconomic standpoint, like unemployment, GDP, also what they see in their own data, like credit delinquencies, write-offs, all those sort of things. They take all those indicators and they have their own models that help determine what this amount should be. And essentially what the provision is how much do they estimate of those loans they made they're not going to end up collecting. And it is, if we take a look at the balance sheet, actually, we'll see what this number kind of feeds into. It feeds into the allowance for credit losses. So to find the allowance for credit loss, or what they're calling here their credit reserves, which essentially means the same thing. I actually had to go to their presentation here, their recent investor presentation, because they didn't have a separate line item for it on their balance sheet. But this is what it is here. So 4.2 billion as of Q1 2020, and then throughout 2020 it went up. So you can understand why it went up. There was more risk in the overall economy in Q4 2020 versus Q1 2020 because an actual recession had happened. GDP had fallen off a lot. And then you can see kind of in the future, it's gradually come down. So what we can interpret that is Amex is basically saying that they think that less of the loans they've made are going to end up being uncollectible. So that's why it's currently at 3 billion versus what it was in Q4 2020 was at 5.6 billion, because there was a lot more risk in the economy based on what they were seeing at that point in time. But a lot of that risk has gotten reduced as a lot of the lockdown measures have been lifted. The economy is starting to come back to normal. However, there are still some risks in the economy. Of course, a lot of people are saying a recession is happening, a recession is imminent. But let's look at some more data points that point to the fact that maybe this isn't the case, at least based off of what Amex is seeing in their data. The one thing I wanted to point out, this is actually their earnings transcript from their earnings call that they had on Friday. And I wanted to point out this thing that their management said, which is the historically low unemployment rate is a positive factor as it's helping to drive our strong credit metrics. So they're saying that overall their credit metrics are currently strong and they continue to see no significant signs of stress on their consumer base. Inflation is a bit of a mixed bag because it's a modest contributor to their growth, but also combined with low unemployment, it puts pressure on their operating costs because they need to pay more to retain their talent. So what they're saying here is based on what they're seeing at least, there isn't that much stress on their consumer base, which doesn't really align with this recession narrative that we've been hearing right now. But it is true what they're saying. I mean, jobs are plentiful right now. The average job seeker has about 2 job openings. So jobs are plentiful, and it's difficult for a recession, I think, to happen if jobs are still plentiful. Because if a recession happens when people have less money, they can't afford things, economic activity starts to slow down. But if people need more money, they have jobs which will allow them to get more money. So the fact that some people are calling for there to be an imminent risk of a recession, to me, what this tells us is that may not be the case. So let's look at some actual data from their earnings release. And I'll start with something that's a little bit more basic and easy to understand and get increasingly technical as I go along. And it's going to start to get pretty technical. So fair warning, I know some people who watch my videos, they like these technical things because they want to learn and they want to dig into the nitty-gritty details. But some people like to keep it high level. So for those who like the details of investing, then this will be more for you. And overall, it was a great release for Amex. Their revenue was up, as we saw. Interest income was up. Transactions volumes were up. Everything was looking good. But what I want to look at here specifically is their write-offs. So what percentage of their loans are outstanding by 30 or more days? This is a general indicator of write-offs because write-offs usually happen when people can't pay back their loans and they just end up writing it off and they don't end up collecting it, which results in a loss for them. So again, if there's a recession happening or we're starting to see signs of a recession, we would see this go up or at least be high relative to where it historically is. Because what would be happening was customers would be tapping into their credit cards to pay them back because they need to in order to pay for their necessities. Because again, we're in a recession, people have less money, so they're relying on credit to make day-to-day purchases, and then they're going delinquent. So if that was starting to happen, we would see at least some signs of this. But if we see it going down or we see it's lower relative to where it is historically, then there's less of a chance of recession because it's an indication that people have money and they're not tapping into their credit cards to make everyday purchases. So I'm going to focus on this metric now. Again, this is more of a consumer facing metric. And what we can see is they've split it out into card member loans and card member receivables, but they're the same. So it's 0.8 as of Q2 2022. So 0.8 of their card member loans are 30 plus days past due. And then card member receivables is the same, 0.8%. Now, let's compare to what this was before 2020. So let's look at the presentation Q4 2019. All right, so this is a few years ago. Let's see what it was at that point. So we'll scroll down and see if we can find a similar, um, here we go, credit metrics. So it's higher, right? Now, this is an interesting trend, and they even actually state explicitly in their 10Q that these write-offs rates are historically low. So that's a key insight, and it seems to not indicate that we're getting close to a recession, because you can see for lending net write-off rates, which I don't know the specifics of why they've named each one, but I'm assuming they're pretty similar. Again, they define them as 30 plus days past due here in 2019, 2.3%, and then 1.9% here compared to what it was here. So it's a lot lower. And 2019, Q4 2019, there's nothing wrong with the economy. Everything was going smoothly. Now we're in a time where inflation is high, supply chain issues, oil's expensive, all these types of things, and it's lower. So to me, this says maybe the consumer isn't as screwed as we're being led to believe. But let's look at a few more things to see if we can paint a more complete picture here. Okay, so the next thing I want to look at is their credit loss reserve. So we already kind of looked at this, but I want to look at this from a different lens to, I guess, help paint the picture of how this number has trended over time and what it can tell us about the health of the consumer and possibly a recession. So they provide some details here. This is on their worldwide card member loans. So these are loans that they have outstanding to their card members. And the number I want to draw your attention to is here. So this percentage of loans number. So what is this? Well, they discuss their loans, the loan balances. So this is all in billions here. So they have 95 billion total loans outstanding as of Q2 2022. And then their credit loss reserve. So what percentage or what amount of those loans do they expect to not end up receiving? And they made some adjustments here. It gets reduced when you have write-offs, but then you also recognize a provision, which we discussed what that is, which increased 272 million, but the ending balance is just under 3 billion. So just under 3 billion out of their 95 billion in total loans they expect to not receive. So that's 3.1%. Now, again, they determine this number based on all the economic indicators there are out there, GDP, unemployment, also what they're getting internally, like from their, credit delinquencies, write-offs that are happening, the data that they have real-time access to. They're all putting it into a model to determine what is the future amounts of loans they're not going to collect. And as a percentage of their total loans, it's 3.1%. Now, it's gone down quite a lot. It's been going down for many quarters. If we look to Q2 2021, it's down 2%, which is very significant because, I mean, that for one, it's going to help the earnings if it actually ends up becoming true, because that's less losses for them. It's less credit that they're not are going to end up not collecting. And then if we compare it to what it was in previous quarters, so this is going back before any of these lockdowns happened. So we can see what it was here. So this percentage of loans number is right here. We can see it was 2.7%. So from Q4 2019 and pretty stagnant, 2.7, before that 2.7, 2.6, 2.6. So the historical average is around 2.6, 2.7%. Now it's 3.1%. So if we compare what it was in a time where there was no problems with the economy, everything was going smoothly, to a time we're at now where all these articles are coming out about the recession, everyone's losing their minds about it, it's gone up a whopping 0.4%. So to me, what that says is, at least based off of what Amex is seeing in their models, which again look at economic data and also their own data that they collect, they're not really concerned about a recession, and they're not concerned about some of these loans they have not getting collected or the customers not being able to pay them back eventually. So they're confident, as they even stated, in the health of the consumer. So again, not really congruent with the recession narrative we're hearing. Okay, so one final metric I want to look at, and this is a much more simple one to understand, is the volume of processed transactions. So you will see this number go down when a recession is happening because it points to an overall slowdown in economic activity because there's less transactions happening. Likely people have less money, money's changing hands less. So there's likely that's an indicator of a recession. And again, Amex is a company that is extremely prevalent. A lot of people process their transactions using Amex. I mean, not as much as Visa or MasterCard, but still a significant portion of the goods and services that get exchanged in an economy, at least in America and Canada and some of these Western economies, happens on Amex. So this would be a good indicator of overall economic activity. So if we look at this number here, process volumes, it's currently at 53.9 billion. So 53.9 billion transactions happened in Q2 2022. So I want to go to this one, which shows recent data, and I'll zoom in a bit so you guys can actually see it. But this shows what this number is, how it's trended historically. And it starts at Q4 2021 and goes back many years. So we can see the process volumes in billions here, 51.9. So it's gone up from 51.9 at the end of 2021 to where it is now 53.9 or whatever it was. But let's scroll back a bit and we can see how this number has trended throughout the quarters. And we can kind of see what happened during, so if you look at the quarters here, Q1 2019, 48 billion. And then it was pretty consistent at that 48.3, 48.5, 50.1. So it went up a bit in Q4 2019, probably because there's generally economic activity is higher towards the end of the year because you have the holiday season. And then once that thing happened in 2020, it fell off a cliff. And we had an actual recession happen at this point. So you can see it went from 50 billion, 42.8, and then 36.3. That's a pretty significant decline. And then it slowly recovered. We can see it keeps going up, and now it's kind of above where it was back the pre-lockdown era. So we can clearly see a correlation there where when there is an actual recession, as there was in early 2020, these process transactions go down. So if we were in a recession or showing signs of a recession, it's unlikely that this number would be at an all-time high. Now, of course, this number can go up if Amex is just taking more market share from Visa or MasterCard, because it's not going to be, completely constant. It can grow just because the company is growing, even if the economy overall isn't growing. But you're not going to see a extreme increase or an extreme decrease unless something were to happen with the economy. It's generally going to be correlated with that. So again, this is another data point that doesn't really seem to play in with this whole recession narrative. And to me, I see a lot of news about this, and there is one article that I wanted to point out, which actually showed that a good chunk of Americans, at least, believe that we're currently in a recession. So this is what this says here. Around 58% of Americans think that the country is in a recession, up from 48% previously. So that's an interesting statistic there, because basically what we're seeing with Amex and what we could probably see with other companies as they release earnings is this doesn't really seem to be the case. The consumer appears to be strong. The company Amex is saying the consumer is strong. They have great credit. Their write-offs are at all-time lows. And really what this is just a media narrative about the economy in a recession, which is just objectively incorrect. And it does annoy me a little bit because of this article that says here that people believe we're in a recession because obviously the average person isn't super informed about the growth rate of the economy, and they probably don't care about it that much. They don't really care about the statistics on looking at them and trying to understand what they mean. But it is kind of this media narrative that's been perpetuated. So that was really the goal of this video, was to just show how you can look at data objectively to determine if we're in a recession. And based on what I'm seeing, it seems there's no indications of a recession. The consumer is healthy. Of course, that's not a prediction of the future, or because things could certainly change in the future. Even if it doesn't happen this year, it could happen 2-3 years down the line. But at least as things are now, it doesn't really appear that a recession is coming and the consumers are overall healthy. So anyways, guys, that pretty much does it for this video. So thank you so much for listening. I hope you did find value in this video. If you did, then please leave a like and subscribe if you're new to my channel. I'll see you guys in the next video.